My name is Mike Boydell. I'm the MD of Shares magazine. My background is nothing to do with stocks and shares. My background is an estate agent, so I'm the devil incarnate. I was a director of a company called Hampton Estate Agents, and we sold the business in 1990. I'm giving you a bit of a background, and it'll evolve. And then I sort of took early retirement. I was in my early 40s. Went trading shares for a living. Spent about 4,000 or 5,000 a month on terminals and data. You can never have enough information, can you, when you're in stocks and shares? And I was buying and selling regularly, probably started with about 8 or 9 different stocks a day. I then, over 5 years, built that up to probably about 220 trades a day. I made a bit of money, and my broker made a huge amount of money out of me. But I did learn the hard way by losing a lot of money. And this is what I'm going to try and show you, is what it's like and to understand the marketplace, because the marketplace does not understand you. The truth is, you don't really know the marketplace. The marketplace is quite random. People always have their opinions, and their opinions invariably cost them money. So I'm going to try and take you through a little bit of a journey about psychology, because I think it's very important you have a psychology, because you need to know your own mindset and the market's mindset before you can start setting up risk and profits and losses. There's also the mentality of you as an individual, because market makers, those evil people who are on the other side of you, when you buy a small cap, generally there's a market maker sat at his desk trying to make money out of you. And they do make money out of you because they have lots of tricks and tactics, and they are there just to piss you off. That's all one aim in life is to piss you off. And you know it, because as soon as you buy a stock, it goes down, doesn't it? As soon as you buy it, it just goes straight down. And it's not personal. You all take it personally. Why have I bought this share? Why didn't I buy it yesterday? But as soon as you buy it, it goes down. And the truth is, the market makers are very clever. They know the psychology. They know the volumes. They can watch the volumes go through the marketplace. So when they see the volumes go up, they can make lots of money out of you. And you buy on the volume. And as soon as the volume stops, they sell, you get caught. And it is that marketplace. It's not engaging enemy. They are there to provide liquidity, but it is a bit of a battle. Now, here, who's got £1 million in a trading? Anybody got £1 million in their investment account? Anybody would like £1 million in their investment account? Okay. Shall I tell you how to do it? It's very, very simple. Start with 10 million. Start with 10 million. Start with £10 million in your account, and you'll end up with £1 million. Because that's really how most investors think about the marketplace. They have absolutely no understanding about when to get out. They get in, and they think they're going to be multi-millionaires overnight. They're going to dream of Ferraris, yachts, holidays, dumping the wife and getting a newer model, or the wives dumping the blokes and getting a newer model. You buy because you're trying to buy a bit of a dream. And that's most people's mentality. I'm not saying you're all like that, and that's what I used to be like. I was chasing the dream, and I actually found that the best way to make money is to make small amounts of money in the marketplace. Set yourself a little bit of a goal. How much is your goal? Well, it depends on the risk tolerance. So somebody on average, small investor would probably be happy to make £50 to £60 a day in the marketplace. Others need 200 a day in the marketplace. So I think what you need to do is start thinking about what are your goals. Oh, clearly we all want to get rich. We want to give up work and become a full-time investor, but it's not going to happen. It will not happen. And all the stories you hear in the newspapers about these multi-millionaire traders, it's not true. They make their money by selling you trading courses. They'll send you, you pay thousands of pounds to be trained by these so-called professionals. The only way they make their money is by selling you trading courses. So don't believe what you read or hear in the newspapers or the radios. It is not true. And that's from personal experience. Having been in the marketplace for 14 years, I then founded a company called ADVFN and floated that on the stock market. I then came out of that, went into Shares magazine, and we sold that business to AJ Bell 18 months ago. So I'm a history of a bit of an entrepreneur, businessman, but I like trading. I don't trade now. I provide the tools for everybody here. I'm the MD of the company who organises the event. So we provide all the tools for you to do the investing. That's my side of the business. I've done I've lost the hair, nerves about my nails from the trading. I can't do it anymore. So, 3 essential components of a successful investor, and this is leading on to the risk management. So, first of all, the psychology. Fear and greed leads to self-destruction, and people are scared of the marketplace. They really are scared. We all do our research, we find a stock, we eventually get into it, and we do it for a number of reasons. Well, it could be a chart, it could be some fundamental reason that you actually like the company accounts. Company accounts are normally 12 months old, and generally you're buying on something that's 12 months old. a little bit dangerous, but there is a marketplace where people buy fundamentals. And then you buy it because you like the technology. And you buy it because you believe it's going to go up. Well, it's this fear and greed thing. Things don't go up because you believe in it. Stocks go up because other people buy it, not because you believe in it. So the best thing to do is not have... I traded without knowing anything about a company. I just used an EPIC code, and I just looked at the trading patterns and the chart. And a very simple chart, and I'll show you the simple chart I used to use. It does away with all this, personalisation of the stock. You don't get too involved in its business or the people. It just becomes a stock and a way of making money. And the best way is to take small amounts out. Don't go for big amounts. Once you get a little bit richer, you can just up the ante. So you might start taking out 20 quid profits and 30 quid profits and 100 quid profits. And I'm talking about short-termism. Long-term, if you put 10,000 in, you probably would want to see a 15 to 20% return before you got out, or before you started to sell some stock. I'm an advocate of not selling everything for a long-term investment. It's when you got to about 20% profit. Just take a little bit out, maybe sell 3%, 4% of your holding, and that starts protecting your profits. So that's quite a good number, 20%. Don't shout at them if it goes wrong, but just remember to take bits out when you can. Trade without emotion. So if you don't really like the company or don't know anything about it, you lose the emotional attachment. Do not read bulletin boards. I found ADVM, made my money from bulletin boards, Money M, bulletin boards. But they are there and they mislead you. You believe the story of people on bulletin boards, and they're only there for one reason, either to encourage you to buy the stocks because they've got the stock. People don't ramp a stock because for fun, they do it because they have an interest. And when people what's called deramp, in other words, are negative about a stock, they either do it because they're short or because they don't want people to be conned by the rampers. So try and take away that emotion about a stock. Don't blame losses on bad luck or others. I used to blame all my losses on my children. My children were at home, I had a study at home, and I had all day to sell my stock. No problem. As soon as they come back from school, noise in the house. Oh, children, why can't you be quiet? I was just going to sell it then. It's my fault, So it's all your fault if it goes wrong. Preserve your capital. And the one thing that amateur investors do is they do cut their winning positions far too quickly, and they run their losing positions. And that's because taking any loss is very, very, very painful. The lesson I learned after 2 years was take the loss quick. And do not look at that stock again. Take it off your monitor and put that money in something that's going up today. Not that something's going down today. Sell, take the hit, and then buy something else that is going up now. Simple, isn't it? Very hard to do in practice. Oops, sorry. I'm just going to talk about what I call investors traders. I've got to cover this to explain some of the tactics. A scalper is somebody who makes dozens or hundreds of trades per day, just scalping for a very tiny profit. It might be quarter of a penny profit. But if they do that a number of times a day, times the volume of shares they're buying, they can make money. But they de-risk it. They close all their positions at night. They don't have a position there. That's called a scalper. Then there's a momentum trader, somebody who looks at the stocks are moving significantly in one direction on high volume, and they try and jump on board to get on that train, that express train of money. The trouble is, are you too late? Has it departed and it's come to a grinding halt? You never know. But momentum is a very powerful investment strategy. If it's going up today, for example, this bottle, that bottle just sat there. What's this next main movement like to be? Is it going to go up, go down, or just stay there? It's going to stay there, isn't it? But if that bottle started to drop, what is the most likely next direction of that bottle? Downwards. And a balloon going up, what is the most likely direction of a balloon going up? To continue to go up. The same in stocks. What is the most likely direction of a falling stock? Where is it likely to go next? Down. So why do people buy stocks that are going down? Cheap. It gets cheaper first though. So the best thing to do is buy things that are going up because of the momentum train behind it. Very simple rule. Technical trading, charting. David Jones is talking about charting. He's done it in here, and I think he's doing it in the main room later. I won't go into detail. Fundamental trading, I call them fundamentalists. I think it's quite funny in a sort of strange way. And I'm not poo-pooing Australia, but I just find that trying to base a company valuation on year-old accounts, it's not current for me. And that's my own personal way. But there are a lot of people who do, and it does work. It's particularly in this marketplace. It's very much a fundamental marketplace now on P ratios and EPSs. For me, it never worked, but there's a huge, huge marketplace currently for that. So those are the 4 types of traders, investors. And I think in the marketplace, you've probably heard, have you heard of black boxes? There are institutions have these weird and wonderful computers called black boxes which auto trade. So you probably hear that all these machines are out there making lots of money for big investment banks, and they are. And they use some very, very, very complicated tool sets and logarithms, but they also use some very simple ones, things like breakouts from highs and lows. So this is a bar chart. This could be a 5-minute chart, could be a 10-minute chart, could be a week chart, could be a year chart. But let's just say it's a daily chart. Stock comes down, it could be an indices or anything, finds a bottom here, climbs back up, finds a lower high, okay, comes down. This bottom is higher than that bottom. That's a positive sign. If that bottom is higher than that one, positive sign 1. If this then breaks above this resistance level, and this is where generally people come back and buy, so it finds support from buyers. Generally it's a round number, or it could be a 5p or 10p mark. There's this level which is a resistance, people stop buying, then it comes back. But if it breaks out through that with a 1, 2, 3, it's a very positive signal, okay? So this is basically playing support and resistance. Very simple tool, no fancy overlays, MRIs, MACDs, MCAs. It's just a very simple visual tool. And the reverse is, if it's too high, double top, or 1, 2, 3 back goes up, sellers come in, buyers come in, sellers come in earlier than previously, negative. If it falls down through there, that's a position you should be getting out, or if you're a trader, you should be going short. But that's a very simple mechanism. So if you were to use that analogy through your charting, let's just start at this point, start at C. Stock comes down to D, up to E, not a buy signal, because we said we'd like a buy signal if that was higher than that, or that had a higher point, that was higher than the other point. Goes up to here, gets interesting, looks like that's higher than that, so it looks like the support is climbing. So, and there's a very small resistance point broken. You might want to buy at that point. Likewise, up, down, do it. And what you would do here is if you bought there, you could set your stop loss there, because you know that this point is a danger area. If it falls down through a previous support level, it is generally deemed to be negative and it could fall quickly. That might be only just a fraction of a penny or 2 pennies. So you might want to look back to a previous point and maybe set your stop loss there. You know that this is your danger area. So in fact, you don't actually know quite what price this is going to be, but before you place your trade, you're thinking this could be a good stock to buy at some point if it breaks above there. I know my stop loss is there. You know your stop loss almost before your entry point. In other words, you can say, well, I want to sell at £1.60 and I want to buy above £1.70. It's lovely to go into a transaction knowing your exit point in the worst case scenario. And this is what I'm going to try and explain to you, is about getting into your position and knowing where your exit point is. So your exit point on a stop loss would be, in theory, there. It goes up and you've got another chance to buy more. Would you buy more? Yes, why would you want to go and find another stock? It's hard enough finding this one in the first place. Another signal to buy. And you would move your stop loss with it. So, for example, if your stop loss was here, you could either move it straight to there, or you could move it to there, or you could have what's called a trailing stop loss. So you would say that difference is, say, 10p. If that goes up a penny, you move your stop loss up a penny. And every time it goes up, it potentially protects your profits as well. So that's two. They can have a fixed stop loss, using a simple chart point, or you could have a trailing one. There are other mechanisms for stop loss, and I will explain those in a few minutes. Sorry, wrong way. And here's an example of a stock. So, stock tanked, technical term, here. There was a sell signal. If you owned it, that would potentially be a sell signal. In other words, sell this stock because it's dangerous. It's going to collapse through the support point's danger area. If you're going to go short, you go short of that. There's another sell point there. Can you see that? And a very small sell point. But if you notice, see those distances? They're getting smaller and smaller. And that's really another clue to you that this movement is reducing. It is not quite as volatile And you should start thinking, I wouldn't sell at that point, because it's come down through, but you're sort of thinking, it's losing its strength. There aren't quite as many sellers around who are buyers, so it bounces back up. Now, you could buy off there. You could buy off there. You'd certainly buy off that, because that clearly was quite a high. And then you could buy off these points. You've got a reversal. You get stopped out on the way back down. And then you probably go short there, or you would sell at that point whilst it tanks back down here. Very simple to understand. When you go home, have a look at, if you've got a chart package or come on to shares or Money AM, look at any stock you own and just look for these bumps. And you'll go, oh my God, this is so simple. And it was a revelation to me. This is what's called turtle trading pattern. I went to America and learned all about it. Cost me a fortune, but I could have just done it simply by looking at the chart myself, to be honest. But it's a simple system. And then that stock just continues from there. It's looking negative. That's it continuing to decline. So you've got another sell point. Another sell point. You have actually got a buy point there. So you, in fact, could lose money. Do you see that? So it's not foolproof. Nothing is in life. Otherwise, I wouldn't be here. I'd be in the Caribbean. But there is an element of danger in all of this. But again, you've got a sell signal, another sell signal. So it's telling you this is a very negative stock. So if you want to go short, great. But if you're more of a long investor, just keep looking and see if you bought off there, how much you'd have made, bought off there, how much you'd have made. Simple system, and great for stop losses. Boydell, anybody heard of Boydell? Haven't we all? Haven't we all been in it at some point? It's a dog of a share, but it's got a life. It's gone up a bit this week. But if you use this system, and I'm not proprietary, great buy signal there, you've got buy signal there, buy signal there, okay, buy signal there, you've got sell signal there, and then you've got a great big sell signal there, another sell signal there. So you should have got out at least £6 or £5. I didn't. I got it at £5.20, or quit it off in the old price. Comes down, very simple. Again, a great big area of support killed. It's here now. What would you do? Well, you'd be having Teflon underpants if you owned it, because it could be going down. It's gone up a bit after yesterday, I think, but it's really quite a danger area. It's just bumping along on the bottom here on this potential support point. If it went up above £2.05, what would you do? Would you buy? If it went up there, if it broke that area of potential resistance, would you buy it?
Yes.
Yeah. If it went down through here, what would you do? You'd sell it. Okay? That's quite easy, isn't it? So just simplify charts. It's really, the charts tell you, without all the fancy overlays and wizardry. And what would you do if you bought it here? Where would you set your stop loss? Down here, wouldn't you? In fact, I'd set it just a tiny fraction above, because everybody's gunning for that. And if it does hit that, it's going to smack down. So I'd probably get out maybe a penny or quarter penny above that. But that would be my buy point. I know my exit point there. Where's my profit point? Well, I don't know where my profit point is, but generally this could be a potential area of profit, because they do say that sometimes resistance turns into support and vice versa. So this could become an area where this goes up to £3, nice round number, and it will come back down. So really what I'm looking for is from £2.10 to make a profit of 90p. And my exit and my risk is 90p there, and my downside is 30p. Risk reward of 3 to 1. Magically perfect risk reward ratio. That's just a pure luck example. That's 3 to 1. I would always work on 3 to 1. If I look at something, I'd say, how much can I make out of this stock to my loss potential? If I can lose 10p, I need to make 30p profit. So that's why I try and look for is a 3 to 1 profit win ratio, because you don't always get it right. If I get it wrong 4 times out of 5, I'm going to be out of the marketplace very, very quickly, because I won't have any money left. So I do try and do this 3 to 1 ratio. Quite clear here that that is a buy point. That's a potential profit point. Would I sell at that point? No, I'd probably just wait, because it could just consolidate and then go up. But I have a feeling at £3, there'll be a lot of people who shorted there will be buying back at that point, because they shorted there, they'll be buying back there. I think it will probably collapse, go up quickly to there and then collapse again. Not investment advice, but just simple risk management and stop losses. A Chinese general, Sun Tzu, said, "Every battle is won before it is fought." The phrase implies that planning and strategy not the battles wins wars. And that's very true. It's actually having a plan in place. And that's to do with risk and money management. You know, why go into the marketplace unless you actually have a strategy of how to get out and when to take your money? Sorry about that. Got this. How much risk am I willing to take? Taking profits and stop losses. So we'll run through that. So when you determine your risk level, you need to determine how much you can afford to lose. So if you have £3,000 with your stockbroker, have you put it in there on the basis that I can afford to lose it? Put your hands up if you put money into a stockbroker account believing that if you lost it, life would be okay. Okay? Well, there's a few people, you're going to lose your money. I'll tell you now. Because you just treat it as not a joke by any means, but you think, I can afford to lose it. Don't need to worry about it if it goes down to zero. And it will go down to zero because you've got no risk management. If you're going to invest in the marketplace, put very small amounts in and just build your confidence. So if you're going with the attitude, you can afford to lose it, you will lose it. But also the amount you can afford to lose will determine the length of your trade and the type of stock that you use. But a lot of people aren't short-term traders like I was. Some people actually like to hold the stuff. I don't know what that is. And get rich slowly. Much better strategy than living your life in the fast lane, watching stocks all day long and your eyes go mad. Long is good, long term is quite good. And especially in the last marketplace, last 18 months has been really, really kind to long-term investors. So those who want less risk tend to set tighter stops. That's obviously quite clear because you don't want to risk your capital. So those who didn't put their hand up are trying to preserve capital. So you will have much tighter stop losses. In other words, if you have a £2 stock, you might set it at 10%. Whereas this lady here, who's prepared to throw it all away like I am, will probably set it at 0%, no, 3%, 4%, 5%, because a much greater amount, 20%. We're prepared to risk greater money compared with those who want to protect their capital. So what's the answer? Where do you set your stop loss? There is no magic formula, but if you're trying to preserve your capital and you're trying to de-risk it, set it tight, better risk it, make it a wider stop loss. The trouble with a tight stop loss is you could be whipsawed. And whipsawing is basically you get in the marketplace, the market moves against you day one, and you're out the next day. And you sit there scratching your head thinking, I am a mug, aren't I? And you buy it back the next day after. And then market makers know this. Market makers will sit there, and I do a level 2 seminar, and the market makers are very clever. Because they'll get you into stock. They know the market mentality. If the market goes down and somebody likes a stock, they will buy more of it because it's cheap. Cheap is good. So they can buy 1 million today, and they can only buy 500,000 yesterday. Oh, I've now got 1.5 million of this crap stock. Fantastic. Market makers know this, so they move the price down to attract the people, bang it up, and bring it back down again. It's called shaking the tree. They'll shake the tree, get these investors in and out, churning their accounts all the time. Yeah, it's dangerous. The other way they do it is by moving the price up. So if the price goes up, people will take a profit. Just natural, isn't it? It also encourages people to buy because people think, oh, it's going up through the roof, so I must buy. So you've got this sort of bit of a battle between sellers and buyers. Again, the market makers will do the same. They will shake the tree. There's all sorts of tactics they'll do to get you in and out. And you'll end up buying something as it goes up, thinking, oh, I've got to get in quickly. You know, before I miss this express, I've got to get in today. And the market makers will slam it straight back on you, knowing he suckered you in to buy the same stock you owned yesterday. They watch volumes, they watch not DIN accounts, personal DIN accounts, but they watch volumes coming in from different brokers. So, for example, you've got TD, they know the volumes coming in from TD because they can see it's a TD stock. So they know what's going on with a TD or Barclays or any broker. They're not stupid. They know when to shake the tree. Profit and loss ratio, 3 to 1. Coincidentally, I looked at the 30p, 10p loss. You might decide to say it's in a monetary term, £300 upside, £100 downside. There's no point in going into an investment if you've got a 50% chance of making money. You might as well put it in the business side. At least you're going to get a guaranteed 1.3% return. So you want to de-risk this by saying, I'm going into this on the basis that I can see a potential upside of 3 to 1. Okay? Very simple maths. Oops, sorry. Calculating expected return. Well, before setting a stop loss and taking profit points, you should, in theory, have a spreadsheet to calculate it. The importance of the calculation can't be overstated. It forces investors and traders to think through their trades and rationalise. Unless you have a system, you'll just buy something on a gamble and hope that it's going to go up or go down. But if you have a system and a spreadsheets, you might need it. A lot of people can just do it in their heads, but if you might need a spreadsheet, and there's a calculation, which we'll send the slides out, about probability of gain times take profit percentage plus and you get a ratio. Okay, I won't go through that. I will send it to you. And it will tell you if this is a good one to invest in or in a short term or not to invest on this pure probability ratio. And Russ talked a little bit earlier on about particular sectors are very, very risky, very volatile, and others are less so. So that forms part of your calculation. Is the sector risky and volatile? Taking profit. So we covered stop loss in a little way. I'll cover it a bit more. Long-term investor sets profit targets to be hit in several years. Developing trading stop loss points allow for profit to be locked in every so often in order to limit your downside. So in other words, a trading stop should allow you to move your stop loss up with your transaction, but also at some point to take a little bit of money out of the marketplace. I'm investing in a company called Concha. It used to be called Hot Tuna. I bought it at 0.35. It's now 2.5 pence. But all the way up, I've sold a little bit. I'm kicking my heels now, of course. But all the way up, I've sold a little slug to protect my initial capital, and I've got a bit of profit, and I've got some stock left. Now, but if I left it all the way up, I made a bit of money, but I didn't, because I have this policy now of taking bits out of the marketplace, because it does your confidence an awful lot of good if you're actually putting something back in your current account occasionally, rather than just dragging it out all the time. You take profit in increments over a period of time to reduce volatility while liquidating, because sometimes, depending on the size of your transaction, in some small caps, you try and sell something in the marketplace, and if it's over normal market size, the market makers will kill you on the price. So sometimes little bits, I know it might cost you a brokerage fee, get a cheap broker, start selling a little bit. And certainly when you made a 25% gain, that's in my mind, 25%, start selling bits of it. Take profits when upside is limited. So you can look at a chart and say, whoa, I'm getting quite close to a previous area of resistance. I might take some profits now because I don't want to risk all my money up there. I want to take a little bit out now, might let some run through till it hits the resistance point. Oh, I just said it there. Stop losses. Never ever buy without first setting a stop loss. There are platforms and systems where when you put your transaction in to buy, I want to buy Barclays at, whatever it is, £3, whatever it is. I want my stop to be at the same time placed at £2.80. That's the system you want. So try and find, I can't give you any names, but try and find a system where you can put your purchase price in and your risk price in at the same time. Because then you don't have to think about it. It's done for you. You haven't got to look at the thing the next day and think, oh my God, it's £2.90 now. Oh no, next day it's £2.85. I'm going to be out of it tomorrow. And you won't. You'll go down to 270, 260, 250 and you buy more. But if you have a system that actually does it for you, you put it in the marketplace when you buy it, it's out of your hands. You can have a nice life, you can have a job, and you can get out and play golf. Never move a stop except in the direction of your trade. Most people will move their stop down rather than up because they don't want to get out of this stock. They actually want to stay in it, and they're prepared to risk even more money. Balmy, as I said earlier on. Why don't you put your money in something that's going up today? So look at your portfolio when you get home. We've all got dogs. I've got 3 dogs in there. I won't sell them. I don't know why. I'm trying to preach to you why I shouldn't do it. Everyone's got some dogs in there. Go through and think, is this stock ever going to go up? And the answer, you'll find something that probably is no. Sell them on Monday and buy something that is going up that day. And your character set will be better. Your bank balance is potentially better. Just try and clear through some of that deadwood, because every time you look at your portfolio, I look at it thinking, did I really do that? And you've probably got some in there, we all have. We won't admit it. Just clear out some of the deadwood. So stop losses could be the straight percentage. A good rule of thumb for a short-term position, somebody who's prepared to, is 5 to 8%. If you're doing a transaction over a period of 2 or 3 days, 5 to 8% is enough, because if it moves more than that, it's going to thump through. If you're a longer-term investor, you might want it at that level as well, because you're looking at protecting your capital. Longer term, another way is to check the stock volatility against the whole market. It's called a beta. Most websites you go to, ours, ShareScope, Investors Chronicle, all of them have a beta calculation. It's a ratio. And if that stock has a beta of between 0 to 2%, then set a stop at about 10 to 20%. If that stock is more volatile, in other words, the price moves up and down a lot. If you look at charts, it's like a heartbeat. If it's very volatile, then you should set a lower stop loss because it could take you out. And then we talked about the chart point. Support and resistance is a very important one. Just going back over, you've probably heard it before and seen before. Minor support, strong resistance, stop loss point, buy point. If you bought there, your stop loss could be there. Buy point, support point, buy there, set your stop here. And here, I don't even know what this stock is. I don't really care what it is. It's a 1.43. You don't, in my strategy, you don't even know what the stock does because you just look at very simple chart patterns. So this is a trade developing. You don't know what the stock is. I would say if it went through there, it's a buy. If it fell down through there, it's a sell. As a trader, I would say it's a short. So what I do is I put what's called a bracket order into my system. I use a quite sophisticated system. And the system would say what's called one cancels the other. So I don't know what I'm going to do, but I do know I want to buy it at that point. So I put an order into buy with a stop loss here. I also put a sell short order in there with my stop loss up there. And I go away for the day or week and come back and find that I'm either long or short. Because the market's done it for me. The market has dictated my position. I don't know whether I'm going to be long or short. It just says to me, there is a trade. Can you see the trade? There's going to be a trade somewhere on this type of system evolving. But I don't know what it's going to be. And I don't really care because in this sort of trader language, it doesn't matter. But if you're an investor, you would be looking for a breakout. So you could put an order in to buy above that point there. Okay? If you're an investor, not a trader. Trading stops, they add flexibility. So if you move your stop loss up with your transaction, it adds some flexibility to it and protects profits as well. Diversification, in the other room before, other people talked about diversification. Concentrate your cash in a few stocks with the best technical traits. 10 stocks, no more. Don't have more than 10. 5 is a good number, but 10 is the right number. More than that, you're going to miss opportunities to sell, miss opportunities to buy. Limit your portfolio, keep an eye on it, how much you have in each. Well, you should spread your risk, but you don't, do you? You put a bit more in that one, a bit less in that one. But really, you should try and rebalance your portfolio, as a fund manager would do. A fund manager would rebalance his portfolio quite regularly. So you need to think a little bit about, have you got too much exposure to a volatile stock? Should you not be taking a bit of money out and spreading it out in something else that is less volatile? So that's called diversification. Don't put it all in the same oil and gas sector or mining sector because you will get stuffed. Spread it out in technical, biotech. If you like something a little bit sexy, spread it out amongst other riskier sectors, or go for some safer FTSE stocks and just have a bit of a balance in your portfolio. If a stock falters at the start of a new advance, it often means you need to sell it. I have bought something, and within a minute I've sold it straight away because something just felt wrong. The volumes have changed, or there's been a tick down. So don't be. If something falters, you might think you're right, and it just goes, something feels wrong, sell it. You'll kick yourself, but it's the best way is to take that loss quickly. And it goes back to my very first slide about most people are very scared to take losses. I'd rather take the loss and let my profits run. It's very hard to do, but you've really got to get that mindset of automatically getting something to sell it for you. That's why have a platform that does it for you. Buy at a price, put your stop loss in. If you want to go out shopping, golfing, whatever, it does it for you. Rather than coming home at night and going, I don't think I want to sell it just yet. I like this stock. Take away that sort of emotional attachment. Sluggish price progress or heavy volume decline right after a breakout to a new price high is worrisome. So in other words, if it's just broken out to a new price, but then the volume starts to decline, it might be a false signal. It might not be breaking through that area of resistance. So just watch out. You don't have to be intraday watching this, but just watch out for small things like that. This is all about risk management. Margin. Anybody use spread betting and CFDs? Few people? Hands up, anybody? A few people. Get rich quick, isn't it? Tax-free profits. I think something like only 3% make profits So it's a nice little marketing trick to get you to have a spread betting account, but you only pay tax on your profits. I always pay my HMRC return. I'd love to pay, if I was paying HMRC $300,000 a year in tax, I would think that would be fantastic. Because it means at least I'm making £400,000 I'm keeping. So tax-free trading is great, but you've got to make a profit first to make it worthwhile, and you've got to think about your tax allowances. So, and leverage, you can go to have a CFD or spread betting and end up buying, you put £1,000 in, you could end up buying £10,000 worth of a stock. In Forex, you could buy £1 million worth of Forex. The trouble is, if £10,000 worth of stock goes down 1%, you've wiped your account out. So just think about your margins, how you use it. They offer you 10 to 1 ratio. Put £1,000 in, have £10,000 worth. I would seriously not use that. Perhaps 2 to 3 times margin if you really want to be in the margin game. Cover your expenses every month. So what you need to do is set yourself a goal each week or each month of how much you would like to take out of the marketplace. And we're talking here about taking market out. You might want to reinvest that money or actually physically take it out into your credit card or onto your bank account. It's just take small amounts out each month. Start with, I want to make £200 a month, and then build that up. Don't get too greedy. It's all about managing your money and your risk. Rather than striving for the big hit, protect your capital first and work for consistent returns. And then once you've got your confidence and you know what you're doing with your risk management, take more aggressive risk with the proportion of profits. So once you've got your money climbing, mentally separate your account. So say you had 10,000 initial investment and you now got 13,000. 10,000 play with more safely. The 3,000, you can be a little bit more aggressive with the risk of that because that's profit. So you're playing with profit. So you can have a slightly different way of looking at the risk and the stop-loss proportion of that money. So always try and protect your initial capital. Profits you can be a little bit more aggressive on. The big profits will still come along, unexpectedly in some cases, but they come along without that excessive risk. And this presentation is all about risk management. How can you de-risk what you're doing? Ooh, that's it. So that hopefully gives you an overview of how traders' view is in terms of stop losses and risk, but also investment styles, what some of the professionals use in terms of stop losses, ratios of risk reward. So we will send you this presentation. So now there's a break until the next session. So thank you all for coming.